September 15th, 2008, a Monday morning that will be remembered forever. Employees of Lehman Brothers arrive at their Manhattan offices to find security guards blocking the doors. After 158 years, one of Wall Street's most prestigious banks has collapsed overnight, the largest bankruptcy in American history. But this isn't just another corporate failure. This is the day the world economy begins to implode. Within months, 9 million Americans will lose their jobs. Millions more will lose their homes. Entire retirement accounts will vanish. The global financial system will come within hours of complete collapse. And it all started so innocently, with a simple dream, the American dream. A house with a white picket fence. This is the story of how that dream became a nightmare, how greed, fraud, and mathematical delusion brought the most powerful economy on earth to its knees. This is the story of the 2008 financial crisis.
The Finance Crash Chronicles.
To understand how everything went wrong, we need to go back. Back to when buying a home was simple. For decades, getting a mortgage in America followed a straightforward process. You walked into a bank, you showed proof of income, a good credit history, and put down 20% of the home's value. The bank gave you a loan, and you spent the next 30 years paying it back. The bank was careful. They had to be. If you defaulted, they lost money. Your mortgage stayed with them from day one until you made that final payment. Simple, safe, boring. But in the 1990s, Wall Street had an idea. Why should banks hold on to mortgages for 30 years? What if they could sell them? This process is called securitization, and here's how it worked. You get a mortgage from your local bank. That bank immediately sells your mortgage to an investment bank on Wall Street. That investment bank takes your mortgage and bundles it with thousands of others, creating something called a mortgage-backed security, or MBS. These securities are then sold to investors around the world. Pension funds, insurance companies, foreign governments, all looking for steady returns backed by American real estate. On paper, it was brilliant. Banks could make more loans because they weren't tying up capital for 30 years. Investors got safe returns. More Americans could buy homes. Everyone wins. But this system had a fatal flaw that nobody wanted to see. You see, when banks could sell mortgages immediately, they stopped caring whether you could actually pay them back. Why would they? The risk was gone. They collected their fees and moved on. Your mortgage became someone else's problem. And when banks stopped caring about risk, very bad things happen. The genie was out of the bottle, and it was about to grant some very dangerous wishes. Meet the subprime mortgage. The name sounds technical, but it's simple. Loans given to people who can't afford them. In traditional banking, these borrowers were too risky. Bad credit, unstable income, no savings. But in this new world of securitization, they became gold mines. Why? Because subprime mortgages charge higher interest rates. Higher rates meant bigger returns for investors. And since everyone believed housing prices only went up, where was the risk? Mortgage brokers spread across America like wildfire, targeting communities that had historically been shut out of home ownership. They weren't offering the American dream. They were selling financial time bombs. Let me describe some of the products they sold. The Ninja Loan. No income, no job, no assets required. Yes, you read that correctly. You could get a $500,000 loan without proving you could pay back a single dollar. The adjustable rate mortgage. Pay almost nothing for 2 years, then watch your payment triple overnight. The interest-only loan. Pay just the interest now, somehow figure out the principal later. The liar's loan. Just tell us what you make. We won't check. These weren't just irresponsible, They were predatory, but they were also incredibly profitable. Here's a real example. A strawberry picker in California earning $14,000 a year was approved for a $720,000 home. The math doesn't just fail, it's absurd. But the broker got his commission. The bank sold the mortgage within days, and somewhere in a Manhattan skyscraper, that loan was bundled with thousands of others and stamped with a seal of approval. Which brings us to the next players in this tragedy, the rating agencies. Standard and Poor's, Moody's, and Fitch. These agencies rated investments for safety. A meant rock solid, as safe as U.S. Treasury bonds. Investors relied on these ratings to decide where to put their money. But here's the problem. The investment banks creating these mortgage-backed securities paid the rating agencies to rate them. Let that sink in. The banks packaging the products paid the people grading them. It's like a student paying their teacher for an A. And the teachers, not wanting to lose lucrative contracts, gave AAA ratings to securities packed with subprime mortgages that were virtually guaranteed to fail. One analyst later testified that they would rate anything, even deals structured by cows, if the fees were high enough. The entire system was rigged, and billions of dollars were flowing through it. With money flooding the market, something predictable happened. Housing prices went insane. From 2000 to 2006, the median home price in America doubled. In hot markets like Las Vegas, Phoenix, and Miami, they tripled. Real estate became the hottest investment in the country. Everyone wanted in. People bought houses they couldn't afford, planning to flip them for profit before the first mortgage payment was due. Investors bought entire city blocks. Construction companies couldn't build fast enough. Cable TV was filled with shows about house flipping and real estate millions. Total mortgage debt in America exploded from $4.8 trillion in 2000 to over $10 trillion by 2007. And everyone repeated the same mantra like a religious chant. Housing prices never go down. It's the safest investment there is. Real estate always recovers. Except that was a lie. A collective delusion that millions of people believed because they wanted to believe it. Housing prices had crashed before. During the Great Depression, they fell by 30%. In Japan in the 1990s, they stagnated for decades. But this time, people convinced themselves it was different. Alan Greenspan, then chairman of the Federal Reserve, called it the Great Moderation, an era where sophisticated financial tools and brilliant minds had tamed economic cycles. Risk, they claimed, had been conquered through mathematics and innovation. But risk doesn't disappear. It just gets hidden, repackaged, disguised. And it was hiding in something called a CDO. A collateralized debt obligation, a CDO, was financial engineering at its most dangerous and most brilliant. Here's how it worked. Take hundreds of mortgage-backed securities, including risky subprime ones, and bundle them into a new product. Slice this product into layers, tranches, with different levels of risk. The top layer gets paid first and is rated AAA. The bottom layer gets paid last and absorbs losses first. Now here's the magic trick. Even if your CDO is packed with subprime garbage, rating agencies would rate 80% of it AAA. Through mathematical models that assume housing prices would never fall, you just transformed toxic waste into investment-grade gold. But Wall Street didn't stop there. They created CDOs made of other CDOs, CDO squared, then CDO cubed. They created synthetic CDOs, essentially bets on CDOs without any actual mortgages backing them. The system became so complex that nobody understood it anymore. Not the people creating them, not the people buying them, not even the regulators supposed to be watching. By 2007, there were over $2 trillion in CDOS circulating through the global financial system. They were in Norwegian pension funds, Florida municipal portfolios, Japanese insurance companies, German regional banks. Everyone owned them. Nobody truly understood them. And every single one rested on the same assumption: housing prices would keep rising forever. But in early 2006, something changed. Housing prices stopped climbing. They plateaued. And then, in 2007, they began to fall. When they did, the house of cards started to collapse. The strawberry picker in California stopped making his mortgage payments. So did the family in Nevada who'd bought with a ninja loan. And the speculator in Florida with 5 properties and no real job. Across America, millions of adjustable rate mortgages adjusted. Monthly payments doubled, tripled. Families who could barely afford $1,500 a month suddenly owed $3,500. They defaulted. Foreclosures began slowly, then accelerated. In mortgage offices nationwide, phones rang off the hook. On Wall Street trading floors, the first cracks appeared. February 2007, New Century Financial, a major subprime lender, warns of bankruptcy. 2 months later, it files. June 2007, 2 Bear Stearns hedge funds heavily invested in subprime mortgages collapse, losing $1.6 billion. August 2007, BNP Paribas, a French bank, freezes 3 funds because they can't determine what their mortgage-backed securities are worth. The market for these assets was freezing. There were no buyers at any price. Central banks around the world began emergency interventions. Stock markets plunged. For the first time, mainstream news started using a phrase that terrified everyone: credit crisis. But the real earthquake was still coming, and it would arrive in September 2008, shattering the world economy in a single week.
The Finance Crash Chronicles.